We've classified assets into current and non-current, and we're going to do the same for liabilities, but it's much easier. With the assets, there can be some which can be a little bit confusing. Is it a current asset or a non-current asset? But with liabilities, the definition is going to be pretty simple. So we're going to put the definition of current liabilities in this column and the definition of non-current liabilities here. And what we're going to say is the first three parts of this are actually identical, and they're just the parts of a regular liability. So we'll say both of these are a present obligation to transfer an economic resource or benefit, usually money, as a result of past events. That's the same. And the only difference here is with this one, we say a current liability, that is one that is reasonably expected to be settled within the next 12 months. And with non-current, this is one that is not required to be settled within the next 12 months. So much simpler. We've got the same sort of time frame that we've got with current and non-current assets, but there's none about is the purpose to resell it and so on. We only need to worry about that with assets. With liabilities, just the date. When is it due? Next 12 months, current. Not within the next 12 months, non-current. So just to look at some common examples, we're going to get these all the time. So just some general rules of ones where you go, well, hang on, it actually could be maybe a little bit of either. What we'll say is a bank overdraft. So when we borrow, overdraw our account, we take out too much. Take out more money than what the balance is. We're always going to assume that that is a current liability. We'll always assume an overdraft will be paid back within 12 months. It'll probably be paid back within a week, usually. You can't leave your bank account overdrawn. So that's definitely a current one. Accounts payable, they're the people that sell us inventory on credit and we don't pay on the day. We agreed to pay later on, say 30 days later. But are they all going to be current? Yeah, we're going to assume that they are. We're going to assume that all accounts payable will be paid within 12 months. And usually that is actually the case. But even if it's not, that's what we assume. What about expenses owing? So we've got last month's phone bill, for example, or last month's rent, or some wages we haven't paid. We are always going to assume that they are current liabilities. We'll always assume we pay any expenses or bills that are owing within 12 months. A topic we'll deal with later on is GST and GST payable. This is when we have to give the government the GST that we've collected, or the Australian Tax Office, ATO, and we are always going to assume that that is due within 12 months. And lastly, we've got loans and mortgages where we borrow money to buy something else. So maybe some equipment, or just for the money, or to buy a property. And what we're going to do with that one is just be a little bit specific and break the mortgage or the loan into two parts. The current liability is the amount to be repaid within 12 months, and the non-current liability is the amount to be repaid after 12 months. So what we might do is just have another video, so the next video, and we'll look at this one in a little bit more detail. How do we do this and how does it change over time? But everything else here, the common examples we're going to get are always going to be current liabilities. So your bank overdraft, accounts payable, expenses owing, and your GST payable are always current liabilities.